Hello everyone. In my financial economics series, I want to introduce this paper with my first video on this topic, the difference between investors and traders. What are the basic difference which make the investors different from traders? And I will also discuss the classification of investors and the type of traders present in the market. So let's find out. In the stock market, there are two types of players, investors and traders. To understand the difference between investors and traders, the first thing which we have to keep in mind is that they have a distinctive perspectives when it comes to buying and selling of securities in the market. So now let us see the difference between the two in detail. The difference between the investors and the traders are studied under time horizon, frequency of transaction, price movements, and trade analysis. So first we take the time horizon, we find that the investor have expectation of profit over long run, whereas the traders have expectation of profit in the short run. Traders do not care about the long-term value of an asset. They want to get in trade and out of trade in a matter of minutes, hours, week, or month. If we talk about the frequency of transaction, we find that the transaction is less frequent for investors. They follow buy and hold approach. Why? Because they buy when there is a dip in the price. Investors find it attractive to enter in the market when the price takes dip or undervalue. Whereas traders, for traders, there is a more frequent transaction. Traders involved in buying and selling of stocks, commodity, currency, and other instruments in the expectation of profit in the short run. If we talk about the price movements, we can see that investors care much more about the long-term price movement. They hope that the value of an asset increases over time. Whereas traders believes in short-term momentum in the price. They often buy when the prices are increasing and sell when the prices are falling and profit the short-term price momentum. If we talk about the analysis, we find that investor believes in fundamental analysis. Their investment decisions are taken on the basis of fundamental analysis, which consists of financial statements, balance sheet of the company, growth potential, economic outcome, price to earning ratios, management forecast, etc. But if we talk about the traders, they have nothing to do with fundamental analysis. They just employ the technical analysis. They use historical charts to study the pattern of the trade. They use moving average and other tools to find out high probability trading setups. So trader plan trade generally around the economic event or a company announcement when the stock become very volatile and grab the profit from the strong movement in the price. Now let us see some more differences between investors and traders. If we talk about the nature of ownership, we find that investors invest in the equity market. They buy the stocks, shares, and they become the shareholder of the company. Whereas traders invest in the derivative market like futures, options, which have certain life, that is expiry. That is the life of the trade, and therefore they are called as the contract holder. The contract survives till expiry. The next is the entitlement for other benefits. If we talk about the other benefits, we find that since investors are the shareholders, so they are entitled for all the other benefits like dividend, voting right, stock bonus, buybacks, stock splits. So they are entitled for all the benefits being the shareholder of the company. But traders have just the contract, they are the contract holders, and that contract expires at the time of expiry, so they are not entitled for any benefits. Now, if we talk about the goals, we find that the goal of the investor is to gradually build wealth over the period of time through buying and holding of portfolio of stocks, basket of stocks, mutual funds, bonds, or other investment. Whereas the goal of the trader is to maximize the return. That means they aim to maximize a return that would be higher than what investor earns in their buy and hold strategy. So if we, on the basis of the past experience, if we compare, we find that the investor may be contented with annual return of 10 to 15%, whereas the traders might see 10% return each month. Another interesting difference between investors and traders is the opportunity for short selling or shorting. What is this short selling? Short selling means you are selling at a high price and buying at a lower price and book the profit. But this short selling is not possible for the investors because investors generally take a long position and they buy from the dip or when the market is undervalued, and then they hold the position till the market reaches its height. But short selling is very common tool for the traders because traders earn the profit from the market when the market is rising, and they also earn the profit from the market when the market is falling. Earning profit from the market when the market is falling is called short selling, where you sell at a high price and buy at a lower price. So therefore we can say that trading profit are generated by buying at a lower price and selling at a higher price within a relatively short period of time. The reverse is also true for the trader. That is, trading profit can be made by selling at a high price and buying to cover at a lower price, and this is called short selling, that is profit in the falling market. Next is what happens when the price goes against expectation. So for investors, while the market inevitably fluctuate, investor will ride out the downturn with the expectations that price will rebound and the losses eventually will be recovered. But traders seek to make profit within the specified period of time and often use protective stop loss to automatically close out losing positions at the predetermined price level. Now the next is the trading style. Trading style means the time frame in which the trading instruments are to be bought and sold. So for investors, trading style is just buy and hold position, but for traders, trading style are of four types, or we can say that traders' trading style generally fall into four categories. Let us find out. Now, as I have already said that trading style refers to the time frame in which trading instruments are bought and sold. So trading style generally falls into four categories. Number one is the positional trader. Number two is the swing trader. Number three is the day trader. And number four is the scalp trader. If you have any question on this presentation, please put your question in the comment section and like and subscribe my channel to get further notification. Thank you so much.